I wrote out a long list of people that I knew from all walks of life. And by the way, I would start with that. Don't prejudge anybody. Don't say, oh, that person doesn't have money, or that person would never lend me money. No prejudgment.
Welcome to the Good Stewards Podcast, the only podcast dedicated to seasoned real estate investors who want to maximize the cash flow potential in their business. We are buy and hold investors with 1,000+ properties and markets across the U.S. who bring an insider's view into the nitty-gritty details of real estate investing. If you're looking to develop the mindset, teams, and systems that can dramatically build your real estate business and net worth, you're in the right place.
Welcome to this episode of the Good Stewards Podcast. I'm Ryan Dossie.
I'm Amanda Perkins.
I'm Bill Sirius.
And I'm Andrew Sirius.
We are going to talk today about private lending and how we use that to build our real estate empire. We're going to talk about finding private lenders to finance your purchases and cultivating a network of private lenders of your own. Before we dive in, we want to connect with you at www.thegoodstewards.com to subscribe to the podcast and receive your free copy of our ebook guide, Don't Make a Profit, Create a Fortune. I think we'll start first with just talking about why we would use private lenders. We get asked that question a lot because people say, why don't you just go to the bank? You can get a loan. The interest rates are 4% right now. Go get your loan. And that works great for a residential home buyer or maybe a real estate investor just getting started, and you can do that. Getting a bank loan from the get-go usually requires a large down payment, and oftentimes a conventional lender isn't going to want to finance repairs, and oftentimes if we're getting a good deal on a property, it needs repairs. So our best bet to limit the amount of cash that we have into our properties is to finance with a private lender from the get-go. And what we're usually doing is trying to finance our purchase price plus our rehab costs in anticipation of what our repair costs or after repair value of our property would be, or our ARV is what we do it. So normally, we're looking for a private lender to fund that initial purchase so that we don't have to go to a bank until after we get down the line, get our property fixed up, moving on. There's different kinds of private lenders. There's, to start out with, there's a lot of hard money lenders, and we define that as higher interest rate with points. Points is usually a percentage of the loan value that you pay. If it was a $100,000 loan, you might pay 12% interest and 4 points, which could be as much as $4,000 from the beginning. It's a little expensive. However, if you have a good enough deal, you might be able to make that financing work for you.
I think one thing I'd point out on hard money, so a point is equal to 1% of the total loan amount that you're borrowing, but you also kind of want to be careful with this. You can get taken advantage of pretty easily when dealing with hard money lenders. I've even met some super successful folks that have paid as high as 20-25% APR once it's actually calculated out. So like 10 and 2 is about the most you should be looking at doing. So just, be careful there. And then obviously, don't give them money up front. If they hit you up through Facebook offering 5% interest and, a $5 million line of credit for anything, chances are it's probably a scam.
I mean, the primary way I've seen people get kind of taken for a ride with hard money lenders is borrowing from hard money lenders.
Yeah, I've never actually used one.
Other than that, no problem.
I mean, it works for flips. I don't think they really work for holds because, I think the average is 12 to 15% interest, 3 to 5 points, which is 3 to 5% of the loan. And then all the fees. They usually got an appraisal. They usually got an inspection.
Like
and
doc
they've got
prep.
all 1,000 different loan processing fees, moving the documents from this side of their desk over to the other side of their desk. That's a $250 fee. There are hard money can work, but I've only seen it work with flips. And even then it cuts into their profit margin quite a bit.
A hard money lender is often wanting to churn their money also, which means they would like to flip it over as often as they can because every time they do, they make those points. And it's really in those points that they make most of their money. So they'll have a a hard reset at 6 months or a hard reset at 1 year or maybe 18 months. So you want to be very cautious and careful about when their reset is, because then they can throw some more points on the loan or jack up the interest rate. And at that point, it becomes very expensive.
I think the last thing I'd point out with regards to hard money is it already takes a ridiculously good deal in order to successfully be able to burr out of something, even with private money, how we're doing it. So, I can't imagine having 2 or 3 times as much holding costs. I mean, you're needing to get something at like 50 cents on the dollar minus repairs to be able to successfully burr out of it. So I think, as Andrew said, it's kind of like the only people I know that are using hard money successfully, they're doing fix and flips. They're not so much involved in the buy and hold side.
I would also reiterate a point Amanda was making about the reason to use private money. And one of the big reasons we use it is the seasoning process that banks have. So with a bank, they will almost exclusively lend on your cost into the property up front. And then I've seen it vary from as soon as you have it fixed and rented to 2 years before they'll lend on the appraised value. So if they're only lending on the cost you have in the property, it doesn't matter if you got a great deal on it. You could have bought it for half of its value, but they'll still only lend on that.
Well, and sometimes they'll just loan for 75% of the cost you have into the value.
Yeah.
The cost you have into the property.
I think, at best, usually. 75% of the cost you have. So if you're into it for 75% of its value, which is our goal in the BRRRR process, and they're only lending 75% of your total cost, purchase and rehab, then you're only getting, 57? You're getting a 57% or 56% loan to value. And really, that's just, you're leaving way too much equity into the property to really take advantage of the power of leverage.
That's also not mutually beneficial. I mean, they're taking advantage of you at the points and the rates they're charging, but then, on top of that, they're barely even funding it. So it's a great deal for them. It's a terrible deal for you.
And that goes for both hard money lenders and banks. I was referring predominantly to banks there, but that's one of the reasons we like using private money, because they will take into account, and by private money, I mean not hard money. We'll get into that more, Amanda. You can pick up from here. But when I say private money, I'm talking about regular people with money to lend. They will take into account. I mean, they have flexibility. They take into account that this property is worth far more than you're buying it for. A bank will not up front.
Well, and that's really what they're going to be looking at is the deal. They're definitely going to know that you're strong as a company. You're strong as a person. The loan is backed well, but they're going to be looking at that deal because that's what their money is secured on the property against. So what we use a lot of is our own cultivated network of what we would call medium money, 8 to 9% money of people that we've developed relationships with or have been referred to. And we reach out to them and put their money on our properties. And the reason why it works so well for us is it's a percentage rate that we can stomach. And also it's a great deal for them. These are people that have money sitting in savings accounts doing nothing. 8% and 9%, that sounds like a pretty good deal to them. They're happy to make that money.
Doing nothing? They're getting like 0.2%. What are you talking about? Nothing.
I think at one point it was almost up to 1%.
Wow.
So,
That is something right there. I mean, they're only, when you take inflation, they're only losing like 1 or 2% a year.
A person really needs to find something out there in the world that they can put their money in. And what are their options? And that's one of the things that you think about when you're talking to potential private lenders. And we can go into a little bit more of how you build a private lender list and the fact that...
Well, Bill, did you want to jump into that? Because
Sure.
You kind of founded your business on a private lender network.
Yeah,
So.
and I kind of, all the dissing I heard about hard money, I started out with hard money, as many people do. I ran into a person, his name was Gordon, and he and I kind of built our business together. Gordon was used to be an agent, and then he was part owner of a agency, and he realized that wasn't for him. He had some family money, and he ran into people who had money. So he started building a large network of lenders, and he became a hard money lender himself. I would call him a medium hard money lender because he wasn't predatory at all about his rates, and I ended up borrowing lots of money from him. But over time, I realized I could meet these people as well. and I started finding my own folks. And stewardship actually got into, particularly during the Great Recession, we started, instead of buy and hold, which was our desired methodology and strategy in real estate investment, we started flipping a lot because it seemed like every month properties were worth less than the month before. And so it was hard to justify a buy and hold strategy during the 2008 to 2011 season of real estate investment. And so during that period of time, we started looking for private money lenders because we just needed them to flip these properties. And necessity is the mother of invention. So I wrote out a long list of people that I knew from all walks of life. And by the way, I would start with that. Don't prejudge anybody. Don't say, oh, that person doesn't have money, or that person would never lend me money. No prejudgment. Just take that out of your mind and just begin after this podcast and write down 30 people's names who you know in your network who may or may not have money. And again, people have limited options out there. Okay, you can put your money into stocks and bonds, but who wants to put all their money into the stock market?
I think a quick stock market way that I've overcome this whenever I've talked to private lenders, because that's the typical thing when we offer 8 or 9, like, well, I can get 10 or 11 in the stock market, and I just use the example of Snapchat. I think it was back in 2017 or 18. One of the Jenners tweeted that Snapchat's new interface sucked. And overnight, Snapchat lost $1 billion in value off of a 17-year-old girl's gut reaction. One tweet sent out, shaved off $1 billion in value. And I'll present that to anybody who I get that objection from and just kind of be like, hey, I don't know about you, but I don't like the idea of a 17-year-old with a cell phone being able to wipe out $1 billion of something I've invested in. Sure, you're on the same page, right? Absolutely.
Well, and the other thing just to point out is if you are invested in the stock market, which many people are, including myself, so I'm not, it's a good vehicle. It's historically, it's going to work out too. It's just this private lending situation feels like you have a little more control over it. But anyway, so the point with the stock market that I always lean back to is when people do private lending, they are secured against a property with a deed of trust that's recorded on the county that the property exists in. And what that means is even if we go belly up and we can't make good on our promise to pay the loan, they own a property. They can foreclose on a property, take it back. I mean, maybe that's not what they want to do, but they still have something of value, and probably that's worth more than what their loan is on it. Because, our aim is to not put a private lender in more than a 75% loan to value situation so that there's a cushion of equity in the event that, we need to refinance, we need to sell. We can easily satisfy our private lender and have money on top of it.
I bet they'd actually even make a profit on that.
Yeah.
If you have that kind of equity margin, I would say we always promise, although you can't put this really in writing, that we would never, if it were to ever come to pass and that we had to return it, we'd just give it back to them. We'd do a deed in lieu of foreclosure and just not make it.
Right. We wouldn't make them
back.
pursue us.
You can say that. And in addition, kind of going back to the point you had before, the historic, our private loans are usually around 8%, and I think the historic stock market is closer to 7% or something like that, which is more than real estate goes up. But real estate is much more of a rolling hill. 2008 being the exception, whereas the stock market, it can skyrocket and then come back crashing back down in a very, very erratic way, which most people are not hugely comfortable with. And a consistent year-over-year 8% return is, I think, something most people would much rather prefer.
Well, I think one of the real perks with stewardship too is the track record that we're able to offer for people that are interested in lending to us. Far exceeds what most people have and what most people offer. And I know myself and several of the other partners actually invest with stewardship. So I think that's a good sign when the members of your organization are investing into it as well. I think that's a good sign for private lenders.
Yeah, and maybe we should talk a little bit about, okay, how do you approach a private lender? And again, let's have a big, long laundry list of folks that are potential private lenders in your life, in your network, business network, social network, on and on. So, I think the first thing is, do you have a track record? And if you don't, that's fine. But if you do, then how can you put together some kind of credibility kit? In the early years, I use a scrapbook, kind of a before and after photos of pictures that showed what we did when we went into a place. And private lenders are kind of excited, and understandably so, to be part of the process of renewing the communities that we're in terms of the real estate in those communities. They see that we're there to make changes, and changes for the better, and they're actually part of it. We've had private lenders who they want to see before and after pictures just because they're tickled pink to see the changes we've made, and they're thrilled to death to be part of that.
Or maybe they were past or current real estate investors themselves, and maybe they're not wanting to do the day-to-day management that it takes to have a real estate investment firm. And this is a way for them to feel connected to that real estate industry in a lot more hands-off, easier approach, because
I think it's kind of like HGTV, of like, it's fun to watch, right? It's more fun to watch if you're financially vested in it, right? So, they can kind of get the excitement of the before and after, but they feel actually included in it. So I think that's another thing that's kind of neat with it. They can almost feel like they're a part of it without, the risk really isn't on them because we're the ones that have to perform. But they can kind of see the before, during, after, get at least. And I mean, we have lenders that'll fund stuff and they don't really care. And we have other lenders that it's like, I want to walk projects with you. I want to see how stuff's going. They want to really feel like they're involved.
So one thing that's worked well for us in cultivating our network is really to just not really be selling a product, kind of let people come to us, let them ask questions. We obviously have a lot of information out there for people to find us and ask questions about it, but most of our current lenders are coming from referrals. And so it's somebody who's our current private lender, and we've done exactly what we've said we'd do. What that means is we're always available to meet with them face to face. We're prompt in our paperwork. Their monthly payments arrive into their bank account every month without hassle, or into their IRA account, which could probably be a whole nother topic to discuss. But we have, we're really good at following through with what we say we do. And in doing that, it makes our current lenders refer people that they know to, that just have money that's doing nothing, to come to us. And Bill has been really the person who's kind of driven the bus as far as growing that network, because he's made good on every single private loan and bank loan that he's had since in 1989. I mean, that's a very proven track record.
And that's, I think, in your mind, you have so many stakeholders in your business. You have partners often, you have residents that you're renting to, you have investors, and you have lenders. And boy, with every stakeholder, you want to have a commitment, a mission statement almost. And for our private lenders, our mission is that they make a good return, and they are never without that return. So it's a commitment that we hold near and dear to us. It's just not, we hope to make good. We will make good with them. And, it is something, of course, there, as Amanda mentioned, we have a recorded trust deed on the property or mortgage, depending on the state we're in. People want to, since people have limited options in their investment, they are looking around for opportunities for them. As a matter of fact, this is a statistic I've heard, that 22% of Americans have at least $100,000 at their disposal. The question is, what are they going to do, and how can they get the best return on that money? Many of them are totally unaware of what this is called, which is generally called trust deed lending, sometimes called mortgage lending. And the reason that they're unaware of it is because financial advisors can't get a commission on it as they can securities like stocks and bonds. So they're not going to tell anybody about trust deed lending, understandably. And as a matter of fact, we've had some people in the financial world give our lenders grief about what they're doing. And that's kind of an unfortunate situation. So I would see yourself as an educator.
Well, and I mean, I just want to jump in and say the reason why the grief is given is because This is not an instrument that a financial advisor can get paid on. They get paid by investing money in securities. This is not a security. This is not something that they're going to earn a commission on. So that's not something they're going to
Right.
recommend.
And we are not lawyers, so you should talk to a lawyer in your state when it comes to this kind of lending, because there are some issues with securities law. But we have, in our experience, been all the way through to Oregon's Securities Commission, and they've looked us over. And the reason we think we got a clean bill of health is because one, in Oregon law, it says that trustee lending is not a security. Second, if it is collateralized on a real piece of property, then it's hard to make the case that it's a security as well. Because if it's just out there and not collateralized, and if you're partnering with people and mixing money together, well, you could run into a problem with that.
So one thing that we've found important to do is really to always be developing and building our relationships. It's a lot easier to be looking for money when it's not a crunch and you don't need it. And so you're not backed into a situation that you don't want to be a part of. So we're always out, talking about what we do, meeting with potential lenders, building our network so that at the time that we do need the funds, we have options. Right now we have a list. We have people who have several $100,000. We have people that we're holding out for a $50,000 loan. And we have places, when our property deal comes down, we can send it out into our network and, find the appropriate person to that. It makes it a lot easier than if you get that property under contract and you think, oh no, how am I going to close it? Maybe you are going to get backed into a situation where you have to go with a harder money lender, maybe not the loan shark money, but if you're developing that network before you need it, it's going to help facilitate the process.
A big piece of that too is in sales, we call it like commission breath, right? You don't ever want them to see you sweat. So if you're approaching a private lender as like hey man, would you like to earn 9% on your money? I need it by Friday. They're like, whoa, this is uncomfortable. I've actually always presented it, and I've heard to present it as, operate almost from the position of how would I handle this conversation if I had $100 million liquid? So it's going to be very like, hey, yeah, we've got this program that we work with people on. We pay 8 to 9% interest. Here's kind of the terms. Here's what the collateral looks like. If that's something you'd be interested in, we could chat and see if you're a good fit. So it's less like I need you to do something and more I have something that you probably want and we can see if it's a good fit for you.
And remember, photos are worth 1,000 words. Is that what we can say here? Because if they can see the property, or even if they could come out and take a look at it, if it's local, all the better. Because again, as we mentioned prior, for them to become part of the process, they are part of your team. So why not treat them as a team member and give them as much information as you possibly can? Hopefully you have a credibility kit. And if you haven't done a deal yet, you are going to start a credibility kit. Like, this is my first deal. Be totally upfront and honest with your private lender of where you're at in the process. It's not worth trying to, make promises you can't keep for sure, or to say you're way down the line when you're not. I think people appreciate honesty, and you want to bring them into your experience so they feel like they're part of it.
The first deal Bill and I actually did together, I had a meeting lined up for us, coffee with a local anesthesiologist who I knew did some lending for some other people. I just said kind of, hey, let's go get coffee and talk. And I actually had a deal already under contract, and I put it in kind of a 1-page pitch deck of here's pictures of the property, here's comps, here's what I got it under contract for, here's repairs, here's what it's worth. So sat down with this guy and I just said, hey, this is kind of what I'm doing. Is that something that would interest you? And kind of slid it over to him. And he was like, man, there's no way you could get that good of a deal. And I already knew I had it. So I kind of just, yeah, we do a lot of things to find off-market properties, yada, yada, yada. And, I kind of ended the conversation with, if I could get a deal like that, is that something you'd be interested in working on? This is in an A-class area. So left the meeting, and I followed up with him the next day and said, hey, I actually ended up getting that property under contract. Would you like to fund it for us? So he'd already pretty much said this was an incredible deal that he wishes he could have bought himself. And then it was kind of, well, you've got the opportunity to partner with us on it now. So that was kind of how we met with him, kind of cold pitch to getting a deal funded, was just kind of, these are kinds of opportunities I come up with. And it just happened to be one that was right there on the chopping block.
So I just kind of wanted to jump in our process, which has been working for us. What we start with really actually goes back to a good deal. But what we're doing when we're looking for a private lender for a property is the first thing we're going to do is put together something that we call a private lending packet. What that is it's a couple page little leaflet that basically identifies our property, spells out what our purchase price is, our rehab budget, and then what we think it's worth after it's after repair value. Like for instance, if we have a property under contract for $50,000 and we think we're going to have like a $25,000 budget for repairs, we'll outline what those, we're going to put a roof in it, we're going to put carpet, new countertops, update the HVAC, etc. And, we're looking for a $75,000 loan to cover that $50,000 purchase price and the $25,000 repairs. And what we think at the end of it is that we'll have a property worth about $100,000 or more. And another thing that we include in our private lending packet is comparables. So like properties in the market, roughly the same size, close to the same age, close square footage, so that they can see that other properties have retailed for amounts similar to what we're selling as the after repair value. And so normally we're going to be trying to cushion ourselves 25% in, that's our best case scenario. So from there, we have a lender with $75,000. Great. We have our closing set up at the title company. We put the two together. In-house, and you don't have to do this in-house. There's companies that would do this for you, but in-house, we will prepare a promissory note with a personal guarantee on it, and then depending on the state, a deed of trust, a trust deed, or a mortgage that is tied to that promissory note. What's important about that is it gets recorded at the county. We can't do anything with the property until that loan is satisfied. So that gets recorded at closing. The private lender wires their funds. We get, from the title company, we get our repair funds. We do the repairs. We set up our private lender payments. Another thing that we do is we put liability insurance on our properties. And in case something happens, in addition, property damage.
Being additionally insured. And that's kind of the buzzword you should think of. Yeah.
Right. And we would put our private lender as an additional surety on our property in case something happens. And actually, this has happened to us a couple of times, actually, in the recent years. In the last few months, we actually had a fire that was a total loss. And what that means is when the insurance company identified how much they were going to pay out, in this case, it was the entire value of the policy, it was issued directly to our company and to our private lender. And our private lender had to sign off on that. So we couldn't just take those funds and do something else with it. In this case, we decided that we would pay off the loan and figure out what we were going to do with that burned out property. But, that's an important piece there. And then, we collect an ACH form from them, which means that we have their bank account information. And every month on the date that the loan started, their monthly interest payment arrives like clockwork into their account. They don't have to look for it. They don't have to take a check to the bank. It just arrives, and then we're taking care of all of the paperwork.
And then every year.
I think one thing I'd point out that Amanda kind of touched on is trust deed or deed of trust versus mortgage. Just Google if your state's a trust deed or a mortgage lending state, or you'll do what I did and pitch a lender on something that doesn't exist in your state.
I kind of want to just go around and let everyone share where they found their first private lender or how that came to be. Ryan, did you want to go first?
Yeah, I'll start. So I think mine is going to be interesting for people because a lot of people are going to be in my position. So I'd done some wholesale deals and that was it. I actually hadn't done a flip. hadn't done a buy and hold deal. I'd literally just, bought and sold contracts. So I actually found my private lender on BiggerPockets. I threw out a post in the marketplace and I said, hey, I'm a wholesaler. I've had some pretty decent success and I'm realizing that I can make more money by closing on some properties and maybe doing some work to them. And I'm interested in partnering with somebody. And the guy who reached out to me is kind of like Bill's first lender, Gordon, was kind of a medium hard money lender. He was charging about 15% interest. And I actually negotiated on my first few. I said, hey, instead of me being obligated to payments for you, I'll actually give you an equity cut of the deal. So he actually ended up making more money that way, but it also kept me from having to make him payments. But literally just a random individual. Comically, he wasn't even based out of the United States. It was a guy out of Australia. And I worked with him for several years. I think for a while, at one point, the most we had out together was about $500,000. And, was just kind of this happen chance. Guy shot me a PM and said, yeah, I think I may be interested. Let's hop on the phone.
One of the first private lenders that I ran into was a gal named Barbara. And I actually bought her house. She ended up with having a bunch of money as a result of that. And she wondered, what am I going to do with that money? So I turned around and I reborrowed it actually on the same house. It was kind of comical in a way, but then she became a good friend and also started loaning us money. And by the way, a good source of funds is people who sell houses because they don't really know what to do with their money. And that can be a ready place to fund your next purchase. But also, Amanda, maybe we'll keep going on, but people have lots of money in IRAs or other non-taxable instruments. How can they join the party in terms of being a private lender?
Many people think their IRA funds can only be used for money market accounts or investing in the stock market. And actually, my first lender was my mom, who had only IRA funds that she was doing nothing with. She had parked them in cash because it was during the recession. And, she just kind of was learning about what I was doing in my work. This was around 2011. And she started asking I have a couple $100,000 in my IRA. It's just sitting cash. It's not earning money. Is that something that could do? You guys could borrow. And we moved it over into a self-directed IRA. There's companies that facilitate that for you, or you can do it on your own. And she's been loaning her IRA funds. So that's worked out great for her. She doesn't have to worry about it being in the stock market. It's doing better than it was in cash. And it's grown over the last 7 years. And she doesn't really worry about it because it's paying right back into her IRA account.
I think the first one I came across was actually a mortgage broker of ours who were working to try to finance an apartment complex, and the deal actually didn't go through. But while working on it, we're discussing our business model, and it's like, that sounds really interesting. Can you talk more about that? And so we basically took a bit of a detour from working on this working on this attempted acquisition of an apartment complex to discuss what we normally do with regards to houses. And he was like, yeah, I think I would like to do that. And so we didn't get the apartment. We ended up getting outbid on that, but we did get a private lender. And I think that's one of the things having that short elevator speech, just kind of telling everybody what you do and what you offer, you don't need to make it really salesy, just explain it and make sure you get the key points, what you do, how it would benefit somebody. And if, oftentimes you're not even expecting it and just somebody's like, that sounds interesting to me. And then you just go from there. So I think just being not annoying, but loud about what you do.
Just in closing here, basically, we've built our business on using private money, and really it's helped us to grow faster. So, you can look at getting into real estate all different ways. People do get into it using conventional lending, and that's great. We use conventional lending. We just choose to use private lending on an upfront. It saves us time. It probably doesn't save us money, but it does work for us. It saves us cash that we don't have to put into our properties because, we're borrowing that purchase price plus the rehab from the get-go. Thanks for listening to this episode with us today. If you liked what you heard, remember to like and subscribe to the podcast and get your free copy of the ebook. You can find us at thegoodstewards.com. For more info, connect with us and submit your questions to us or topics you'd like us to talk about. Thanks for joining us today.